If you own an annuity and you're considering surrendering that annuity to either take the cash or transfer it to another type of investment, it's very important to understand how the surrender fees work for annuities, as well as the tax liability that could be generated during the surrender process. Hello, everyone. I am Michael Ruger. I am the managing partner of Greenbush Financial Group. The topic today on annuities. Oftentimes, we have new clients coming to us from other places, and they'll say, hey, I bought this annuity a few years ago, not sure if it's the right fit. Unfortunately, for a lot of clients, a broker sold them an annuity. It wasn't necessarily the right fit for them, but it paid the broker a big commission. So a few years down the road, we're now trying to decide what it's going to take to potentially surrender the annuity from taxes, surrender fees, and does it make sense to move it to a different investment solution? But as I mentioned in the intro, the two important considerations before actually surrendering an annuity and moving it to a different investment vehicle or taking the cash is assessing whether you're going to get hit with surrender fees from the annuity company or what type of tax liability could be generated as part of the surrender process. We'll start off by covering the surrender fees. So when you purchase an annuity, it's actually common they have a surrender fee schedule, which is a set number of years that if you purchase that annuity and then sell it within that set number of years, the annuity company hits you with a penalty. And normally the surrender schedules have a de-escalating percentage fee, which means it might be, let's say, a 7-year surrender fee schedule that in year 1, if you got rid of it, you get hit with that 8%. Year 2, it's a 7%. Year 3, it's a 6%. And it usually starts moving lower the further you go into the annuity contract. But these surrender fee schedules vary greatly from company to company. Some are 7-year, some are 5-year, and some are 8-year plus. You really have to look and see what those penalties are within your annuity contract. And an example would be if you put $100,000 into, let's say, a non-qualified annuity and it had a 7-year surrender schedule in year 2, there was a 7% surrender fee that's charged to you. If you went and surrendered that annuity policy in year 2, you get hit with a $7,000 penalty before you're able to take the rest of your account balance out. While surrender fees can sometimes be a deterrent for an investor to actually surrender that policy before all the surrender fees have run their course, it does sometimes make sense for individuals to pay those surrender fees so they can then go ahead and move on to a more promising investment solution. An example might be someone who's held on to a non-qualified annuity for, let's say, 6 years, and if they surrender today, it's a 3% penalty, but it would otherwise require them to hold on to it for another 2 years when they could be earning potentially a higher investment return in another vehicle and may be worth paying the 3% today and just moving on. That decision is obviously more difficult if you're just a year or two into this annuity and it has a sizable surrender fee like 8% or 7% out of the gates. Then you really need to do a true analysis to see if surrendering that annuity policy now makes sense or if that decision should be delayed until a later year. The second part of the analysis is determining whether or not that investor is going to incur a tax liability when they surrender that annuity. So we're going to assume for this example that you have a non-qualified annuity, which means you made an after-tax investment in this annuity and it has grown versus a qualified annuity, which is an IRA, which if you take distributions from those, it's all taxable if it's a pre-tax IRA account. So in a non-qualified annuity scenario, say you put $100,000 into this thing, it's grown and it's now $110,000 cash surrender value, that $10,000 gain will be taxed to you at ordinary income tax rates. And that is true regardless of how long you've actually owned that annuity, because all gains in annuity contracts are taxed at ordinary income tax rates, as opposed to over in the stock world. If you hold a stock holding for more than 12 months, you get long-term gain preferential tax treatment. Now, on the flip side of that, if you go to surrender the policy and you realize the cash surrender value is below what your initial investment was in the contract, you have no tax liability to worry about because it never made any money. To determine whether or not there's a taxable gain built up in your non-qualified annuity, we typically recommend to clients that they reach directly out to the insurance company to ask, what is my cost based in the policy? What is the cash surrender value? And what would be the taxable gain if I surrender this thing today? And usually the insurance company can give you that information. You don't have to reach out to the broker that sold you the policy. You can go directly to the insurance company to get that information. There are tax strategies that we use for our clients that surrender these non-qualified annuities that then generate a taxable gain. One of them is if clients are very close to retirement, we might say, hey, if you surrender this non-qualified annuity, it's going to create a $15,000 gain. But since you're going to retire next year, let's just wait until next year to surrender the annuity. So then we can push that $15,000 taxable gain into a year that you have very little income. For clients that are still working, we might ask them a question saying, how much are you putting into your company sponsored 401k each year? If they have room to put in another, let's say, $15,000 pre-tax in the 401k, they can surrender the annuity, generate that $15,000 in income tax. But then if they put the $15,000 in their 401k via salary deferrals, then essentially that wipes out the income tax liability that's being generated on the annuity side. This decision of whether or not to surrender does absolutely vary from person to person. What is that person's surrender fees? What is that individual's tax liability, if any at all, if they were to surrender that annuity policy? Obviously, as the surrender fees get bigger, the tax liabilities get bigger. There's a lot more planning that needs to happen. And also, what are you going to be doing with that cash? What is the investment opportunity that sits on the other side of that surrender? And does that offset some of the fees and tax liability you may be incurring as part of the surrender process? I hope this information was helpful. If you have any questions, please feel free to reach out to me at greenbushfinancial.com. Thank you.